Hello, good day. I hope you are fine. A good grasp of the principles of valuation is essential for many areas of financial management. For investors, understanding how to value common stock is an important part of the investment process. Stock valuation is also an important tool for financial managers. As financial managers work to maximize the stock price, they need to understand the factors that determine the value of stock. This video provides an understanding of the main ways of valuing companies and common stock, and of the limitation of these methods. Valuation is an imprecise art, requiring a blend of theoretical analysis and practical skills. Stay tuned and let's learn together. There are three common valuation methods covered in this video. The methods include accounting-based valuation, dividend discount model, and valuation by comparables. I have scaffolded the materials by numbering. You can see a huge number at the beginning of the slides on each valuation method. I hope this will add clarity to your learning process. Let's proceed. A first place to start the common stock valuation would be the firm's balance sheet. Each quarter, the company publishes a balance sheet which lists the value of the firm's assets and liabilities. Book value of equity is the difference between the value of the assets and the liabilities. We could say that a firm's value is equal to its net assets. If all the firm's assets were sold at the accounting value and all the firm's liabilities are fully paid, the remaining amount divided among the common stockholders is the book value per share. Share price can be estimated from the book value per share. The accounting valuation method has a few limitations. This method relies on historical balance sheet data. Book values are historical costs that do not incorporate inflation. Book values usually exclude intangible assets such as goodwill, workforce skill, brand reputation, trademarks, patents, and etc. Book values also do not capture going concern value. Therefore, it is more appropriate to use a valuation technique that is based on future income flows. Investors buy stocks for future returns. Accounting-based valuation method is useful in the following situations: when the firms are in financial distress, when the firms have no current earning, when the firms do not pay dividends, when the firms are first quoted, and when the firms derive most of their values directly from their assets. In such a case, valuation methods based on income flows may not be useful. After learning about the limitations of accounting-based valuation, we shall move on to dividend valuation model. The future cash flows to the owner of common stock are the future dividends per share that the company will pay out. Thus, based on the logic of present value and discounted cash flow concepts, the value of a share of common stock today is equal to the present value of all expected future dividends per share that it is expected to provide. Next, we are going to discuss in more detail how dividend valuation model is derived. I hope this will help you to understand the logic and concepts behind the formula that you are going to apply subsequently. If investor purchases a stock, and holds it for one period, what payment will he receive? He will receive cash dividends and capital gains or losses. Capital gains or losses is due to change in the share price. Suppose that the current price of a share is P0. The expected price at the end of the period is P1. The expected dividend per share is DIV1, and R represents the discount rate or opportunity cost of capital. The rate of return that investors expect from this share over the next year, R, is defined as the expected dividend per share, DIV1, plus the expected price change, P1 minus P0, all divided by the price at the start of the period, P0. Rearranging the formula and using R as a discount rate to calculate the present value, the fair price of a share today can be expressed in the formula P0, where price today is the present value of expected dividend and expected price at the end of the period. This formula is a simple dividend valuation model for one period. What about next year's price? Future stock prices are not easy to forecast directly. If our price formula holds now, it ought to hold then as well. A year from now, investors will be looking out at dividends in year 2 and the price at the end of year 2. Thus, we can forecast P1 by forecasting DIV2 and P2. The price next year, P1, is equal to expected dividend in year 2 plus the expected price at the end of year 2, discounted by 1 plus R to derive the present value. Substituting the equation of P1, we can express P0 in terms of DIV1, DIV2, and P2. For t successive substitutions of this kind, the formula can be expressed as the summation of the present value of expected dividends for t periods and the present value of the expected price at the end of period t. When t approaches infinity, the equation can be expressed with t equals to infinity. The discounted dividend model assumes the market-determined discount rate is constant for all future periods. Only one discount rate is used to discount all future dividends. However, such assumption is only a best guess about what will happen in the future. In fact, interest rates and risk profiles of companies change over time. One could use a different expected future rate in each period for discounting. But again, the discount rates cannot be determined with accuracy too. The second problem is about forecasting future dividends. It is a bigger problem, as the forecast cannot be done with accuracy. There are two solutions to the problem. First is to extrapolate future dividend from historical data. Second is to use a constant growth dividend model. The constant growth dividend discount model is one of the most widely cited dividend valuation approach. The model is used to determine the intrinsic value of stock. It assumes that dividends will grow at a constant rate in perpetuity. This model was developed by Professor Myron Gordon, hence called Gordon Growth Model. Because the model assumes a constant growth rate, it is generally used for companies with stable growth rate in dividend per share. Let's look into an example. The firm has just paid a dividend of 10 pence per share and the growth rate of dividends is 7% per annum. The discount rate is 11% per annum. The current dividend is 10 pence. Therefore, the dividend for next year is 10 times 1 plus 0.07 and is equal to 10.7 pence. The fair price of the stock can be calculated with the Gordon Growth model, as shown in the formula and working. Happy trying! The price-earning ratio approach is a popular technique used to estimate the firm's share value. The price-earning ratio reflects the amount investors are willing to pay for each dollar of earnings. A historical PE ratio is defined as price per share to the ratio of last year's earnings per share, or market capitalization divided by total earnings. The average PE ratio in a particular industry can be used as a guide to a firm's value. Let's look into an example. Suppose you have two firms, cash cow and growth prospects. Calculate the PE ratio. Which company has a higher PE ratio? The answer is growth prospect. Why is that so? Why some companies have higher PE ratio? PE ratios are higher for firms with strong growth prospects, well managed, and have relatively little risk. Investors are willing to pay a higher price for good companies. The PE ratio can be used to set up a growth formula for determining the fair price of stocks. Recall from the formula of Gordon Growth model. Dividing both sides of the equation by next year's expected earnings, and you will get a new equation. The left-hand side of the equation is a forward PE ratio, with price today divided by expected earnings 1 year later. On the right-hand side of the equation, the numerator is the expected dividend payout ratio. So, this equation shows that the price-earning ratio that you would be willing to pay is influenced by the payout ratio. Here is an example on how to apply the PE ratio to value stock. Based on the dividend payout ratio of 50%, discount rate of 16%, and growth rate of 10%, the fair PE ratio of the firm is 8.33. If the current market PE ratio is higher than 8.33, the stock is overvalued or too expensive, and we would not want to buy them. The PE ratios have some limitations. The denominator is an accounting value. Different accounting policies undermine the comparisons of PE across different companies and countries. For example, the difference in accounting policies include the depreciation method used, amortization, and tax system. In addition, there is a concern if firms would engage in earnings management to lower the PE ratios and make the share price valuation more attractive. The PE ratio does not tell us if we should invest in stocks with high PE ratios or low PE ratios. It is important to compare a firm's PE ratio with industry norms and historical levels. Lastly, the PE ratios cannot be used to value new firms that have no earnings or firms with negative earnings. Besides PE ratio, there are other valuation ratios. The common relative valuation ratios are market to book, price to cash flow, and price to sales ratio. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe, or share. Thank you. See you and goodbye.